got some great information from Tyler here, and this is what I see when I'm looking at this place. I see a lot of opportunities for depreciation, and I'm going to walk you through what's going to happen with your money as a limited investor in a project like this with Tyler once you give him his money. So look at this.
But I will finish with Tyler. We can ask him more because he has to go.
Let's keep Tyler here. Let's keep Tyler here.
But
let's actually not any of this. Don't edit any of this out, by the way. We're going to keep it natural.
I like it better like this.
So here's what I'm seeing here is right now, Tyler's going to do a cost segregation on this property, and we're going to create a lot of tax losses here. Depending on what year you are watching this video and what happens with the election, the tax code is going to impact how much depreciation is generated from that cost segregation study. But I would approximate somewhere between 20 to 30% of purchase price or the investment of the LPs turning into a tax deduction from this cost segregation study. And what's going to help increase it? We got the pool. All this pool right here is a nice source of 15-year life land improvement bonus depreciation. You might get some up front, some compressed over time. Also the fencing right here, bonus depreciation. You're also going to see here when they do the renovations, they're going to try to increase the value of these rentals, and they're going to do some renovations of the cabinetry, maybe install new stoves and refrigerators, all beautiful sources of bonus depreciation. Unless you are a real estate professional, or maybe a small handful of you guys have passive income, you're not going to see a lot of reduction in your income from these tax losses. They're just going to sit on your 1040 and carry forward and carry forward. And that's not a bad thing though, because here's what's going to happen. They're going to improve the value of the property, drive efficiency, reduce costs, and eventually they're going to do a cash out refi, and you're going to get maybe 20 to 40%, wouldn't you say, of your contribution back?
Potentially.
Yeah, potentially.
So how long are you planning to hold this property for?
So we've got 5-year fixed rate agency financing for this particular property. So it probably will be pretty close to a 5-year hold period, but it's one of those things where you can never know for sure. There's a lot of market factors that kind of go into it, but as of right now, that's what we had planned for.
So yeah, so basically sometimes they have the opportunity to refi when the value goes so high, and they can borrow from the additional equity and give returns back to the investors. Now that doesn't always make sense, because if the interest rates on the refi may not make sense. So in this example, it may not be possible, but it may be possible. And so some of the things you want to think about as an LP though, you're going to have all these losses from the cost segregation hitting your 1040, and then you get cash flow from your investments and distributions. And let's say we reinvest into other projects along the way. Eventually this is going to sell for a 100% profit after 5 years. That's what we're expecting to see, right?
That's the plan.
We're going to double the money, and then there's some recapture on that depreciation. But what's going to happen here is you're going to pay no taxes on all the cash that comes in for your share of the rental income and distributions. And then on the exit, some of those losses that were unused are going to carry forward, and they're going to offset the profitability. And when you've reinvested your profits in other rentals, those are all going to do cost segs too. So you're building up this reserve of unused passive losses, assuming you can't use them and you don't have reps, and they're going to offset this capital gain, and there's a good chance you may not pay any taxes at all on doubling your money in this investment. So that's some really cool
So that's
stuff.
also going to increase the ROI too.
Oh,
right?
Absolutely. Not only is it an ROI, but it's a very tax-advantaged ROI. There's no way that the profit and the money coming in here is going to be it's going to be so much more advantageous than the money you're pulling in at your W-2 job or even the business that you own, because all this is being offset by depreciation and using leverage and all the tax incentives available for real estate.
Because you can also put money in different vehicles, right? Like you can put it into, like, if you want to go conservative, you can put in a CD and other vehicle. But however, you want to consider like how much is it that you're gonna left over that you can spend, right? Because a portion of it of like the earnings that you receive, a portion of it has to go to taxes. But when you invest to real estate, you get cash flow distribution. You don't have to pay any taxes.
Exactly, because the depreciation offsets it, and then you double your money. And if you plan things right, you may not pay any taxes on doubling your money.
Wow, that's so wonderful.
And one other thing too that I can mention as well in terms of like, mixing your investments, you had mentioned investing in CDs, like doing things that are more conservative. One way that we structure our multifamily deals is we have different share classes that give people different investment options if they have different risk profiles, right? So we have a Class A share, and basically that's straight 10% cash flow, but it has no upside on the end. And that particular class of shares sits higher in the waterfall, so they get the first claim on cash flows from a property. And then we've got Class B shares where they don't get that 10%. They've got a lower preferred rate of return, but they get the equity upside on the end as well. So the Class B shares is a bit more of a risky positioning in the equity stack, but you get the upside on the end. And the Class A, higher cash flow, but not as much upside. So the Class A is a bit of a lower risk sort of investment.
Oh, I see. And what about in terms of liability? What's the difference between general partner and limited partner? Maybe we can touch base on that. I understand what are the differences, but maybe you can talk about that a little bit.
That's a great question. It's one that I'm really glad you brought up too, because it's a huge benefit of investing passively in these sort of deals, is because as a limited partner, your risk is basically limited to the amount of the money that you put in the deal. You don't have any liability beyond that. Whereas let's say you took that same $50,000, $100,000, whatever it is, and you go out and buy a duplex or a fourplex or something like that. Well, let's say somebody dies on the property or there's some sort of accident on the property or something like that. I mean, your liability, of course, you'd have insurance in that situation, but your liability could be somewhat uncapped. Whereas as an LP, if you're investing in the deal, you're basically limited to the amount of your investment. Whereas the folks who are the GP, we have kind of more of the broader risk on the deal. But as an LP, again, you're kind of limited to the amount of your investment.
Awesome. Anything else to add? Mark Perlberg, CPA.
This is cool.
And yeah, that's why, because all this benefit combined, that's why I like to look into, like to invest into multifamily. And whether as a GP or LP, it depends on, how much involved you want to have in the property. Like if you want to go passive, so you can more like hand off, and you have more time to spend with your family and do something that what matter to you. But if you choose to be more active, participated, you maybe want to consider to be as a general partner. So that's also, you have to decide that for yourself. It depends on your goal.